Sunday, March 20th, 2022. This is the second video of the day. Like I said, I was going to do 3 videos of the day. Before I get into this video, I want to remind you guys that I have 436 people on YouTube that are subscribed. I have, I think, like 625 people that follow me on Twitter. And even my Reddit sub, which is the largest form of social media, has 6,650 members at Ultimate Traders. I say this because I want to remind you all that I have no influence on stocks. I do not get paid on YouTube, Reddit, or Twitter. I'm getting no compensation for this. I'm not saying this because I want to get compensation, but I want you all, viewers, anyone that's on my Twitter, on my Reddit, on my YouTube, to know that, hey, I have no interest. Like, I'm not, whatever my opinions are here, or even what I'm doing on Twitter, although I am getting some traction in Twitter, is not affecting the stock price. So it's not like I give you guys something and then boom, I make bank by giving you guys information, because there's too many furrows out there that bank by either selling you a subscription, by front loading, which means that they buy the stock first and then boom, they tell all the followers. Okay, I don't have a lot of followers anywhere. I don't get paid by views, so I want you to know that. So I'm going to go into the state of the market and what is going to happen, not what might happen. What's going to happen. When is the thing I'm not sure about. What I can say is that it's going to happen by the middle of May or the end of May. And I'm already prepping myself, which will be video 3. But I'm giving all this because I want you guys to know I'm not paid for this. So what I'm doing here, like, I'm not trying to gain or to control stocks, or it's not me bringing down the NASDAQ or S&P and the Dow. But basically, if you watch my videos even from the beginning of January, I think my last videos were right before the war started, like right before Valentine's Day, actually, February 13th, which is actually 5 weeks ago. 5 weeks ago. So I'm not a Debbie Downer. Okay, I've been doing this so long that, you know, I'm actually bull by nature. I'm actually a bull by nature, but I go by the data, because whatever the data tells me is what tells me what to do. So once again, I'm not a Debbie Downer. Every single day I'm getting either on Twitter or Reddit that I'm trying to bring down the market. Okay, I'm not bringing down the market. I'm seeing what information, what data is given to me, and by my experience, I'm using my probability on what's going to happen. Once you do this for a very long time, you understand that it's not possible to time the perfect bottom or the perfect top. Now, if you're a day trader scalping and you're watching level 2s, you could time the perfect top or the perfect bottom for that wave. A stock will have a lot of waves, ups and downs throughout the day. So you might be able to time the perfect top and the perfect bottom with RSIs, MACDs, stochastics, level 2s, but on one wave. But what if the stock has 10 waves during the day? So we're not going to get into that. If you're doing this a long time, you have to understand that there's no possible way to time the perfect top, perfect bottom. I tell people to buy increments. I don't really buy increments. I buy 2 blocks, usually 2 blocks, maybe 3 or 4, but generally 2 blocks. And when I buy something, before I buy a dip, I wait 10%, like usually close to 10%, to buy another dip. So if I need to exit, I sell somewhere in the middle of that 10%, 5%, or maybe a small gain like 6%. That's my exit strategy. But we're not going into that. I'm trying to tell you that I'm not a Debbie Downer. The facts are really bad. So the state of the market is really bad. So what do we know? We know with CPI, inflation is near 8%, right? No one can argue with that. We see the CPI 7.9, which is at a 40-year high. We have earnings report that's been coming out. You know, we still have a little bit coming out, but it's pretty much over. The first quarter of 2022 ends March 31st, and most earnings start to kick off on the third week of April with like the banks like Goldman Sachs, J.P. Morgan, uh, J.P. Morgan, Citi, Wells Fargo. So a lot of the banks kick off on the third week. So that's when we're going to find out what happened in the first quarter, and that's why I'm saying is right now the market's rallied this week. I tell my generals and my team all the time, well, not all the time, but this whole week, that we got bad news, and the Nasdaq basically went from 12,500 to 3,900. Now, I'm not going to be, the one just saying horrible things. Take advantage of that. I had a couple of calls this week on UPST that I was trading a lot because I like Upstart. Upstart smashed earnings. And it went from $85 to like $125 in a week. That's what happens on a bull run. So we can actually make more money on a bull run than we can on a bear market. Now, I started shorting via puts in October, but I didn't think it was going to drop from 16,200 to 12,500 in a matter of 2 months. If I did, I would have held on to shorts, but who knows? But I kept hopping in different puts. So this week on the NASDAQ, we recovered 1,400 points on bad news. Not okay news, not bad news. Why? The war's still raging on. So we just said inflation's at 8%. Earnings are coming out. Every single company, even the ones that are beating, are saying inflation, wage inflation, supply chain constraints, chip shortages. They're all saying the same things. So what does that tell you? They want to be mentioning this, and unless they have some kind of foresight that for the next quarter or 2 quarters, they might miss on top or bottom. Or, I'm not saying both, but or. It might be that they miss on both. So 1, we have inflation going through the roof. 2, we have companies just basically telling you they might miss. And then 3, we got this war going on. And with this war going on, what do we see? We see the cost of energy and gasoline rising. So what does that do to the inflation? It makes the inflation rise even more, right? We got the inflation rising even more. So that's 3. So 1, inflation. 2, earnings. And to me, this earnings being bad is a lot more important than 1, but they go together, the inflation. 3, we got the war going on, and who knows how long this could be. And I'm telling people that if we have gasoline prices at close to $5, in New York it's around $5. If we have gasoline prices at $5 for 2 months, consumer spending is close to 70%, 70% of gross domestic product. Close to it. Might be a little bit lower, but close to it. So if the consumer can't spend because the price on the gasoline that they spend, like yesterday just filled up, it was close to $100 on one of my cars. So if you're spending $4 more a week, 4 weeks, like $200, $150 to $200, how many people can spend that and live? Unfortunately, majority of us in the United States are paycheck to paycheck. They cannot do that. So that's going to make earnings get even worse. And inflation. So number 1, inflation is going to go higher. 2, earnings are going to be even worse. And 3, the war is causing all this. So if we get 2 straight months, oil prices, the barrel near 120, and the gas stations are close to $5, boom, earnings are going to go way down. And then 4, we got this political regulatory tension with China, which honestly is huge because we don't do that much business with Russia. But now we're trying to say, China better not help Russia. I mean, I'm not here to say that's good or bad, but we definitely do not want to sour anything with China. And fortunately, China sees what's happening to Ukraine and Russia, and maybe they'll want to go take over Taiwan, because my concern was if Russia takes over Ukraine and nothing is done, that China is going to watch and do the same thing with Taiwan. I'm not saying it won't happen, but I think it's a lot less possible now after to see what's happening. So that's 4. 5, China has COVID now. Well, they had COVID before, but they have a wide COVID span. They had more shutdowns. So what does more shutdowns mean? It means it means that they won't be buying as much. It means more chip shortages, more strength constraints. And then six, and this is very important, Wednesday, the Fed raised rates just 0.25% and opened the window for another 6 or more rate hikes. So right now, with the Fed funds rate is at 0.5%. Okay, most of our companies will be fine if we go from 0.5 to 1%. But I will tell you that most companies will not be fine if we go from 0.5 now to 2%. And I'm going to use Boeing as an example. I did a video on what happens to our companies if we have interest rates hikes. Boeing has close to $100 billion in debt. So for 2%, because the Fed's basically said we're going to get 2% at least. So if Boeing gets 2%, interest rate hikes to 2%, Boeing doesn't even pay the principal. Boeing is paying just the interest. And imagine just 2%. That's $2 billion a year, or $500 million a quarter. Okay, Boeing does not make $500 million a quarter. They lost close to $4 billion in 2020, maybe more than $4 billion. And 2021, which ended, they lost close to $500 million. So they lost money. So can you imagine their cost just in interest expense goes up $2 billion? What happens to earnings? You tell me. So one, inflation CPI is going through the roof. Two, earnings are going to be bad. Three, the war in Russia, Ukraine, which is making one go worse, and two, it's making everything go worse. What are you going to do? Going to make everything go worse. Four was so we had the China thing, China political, regulatory. We don't want that. 5, COVID in China. 5 and 6, the interest rate hikes. So I'm not a Debbie Downer. We're looking at the facts. Why did the Nasdaq go from 12,500 to 13,900 in a span of just 1 week? And I'm down heavy on my puts. The market is generally bullish. People make a lot more money when everyone is bullish. But for me, I want to go in and be bullish when the data tells me. You know, when the war stops, when inflation goes down, when the rate hikes have already ceased. Like, the only way we can combat interest rate hikes for companies, I'm not talking about for America, but for companies, is to slam earnings. And number two, earnings are not going to be slamming. So when you have the combination of these 6 things, things are not going to be good. Now, I'm not on TV, so you don't have to worry about me affecting the market. But these are the facts. If I was on TV, if I was on CNBC, things would be really bad. I'd probably be booed off, and they wouldn't want to invite me back on CNBC. But now that you see the facts, please comment at Ultimate Traders on Reddit. Please comment on Twitter. Please comment on YouTube. And you tell me what are the great things. Because I've seen these debates on CNBC, and they're wrong. They're wrong, because I'm the one that's telling you the S&P 500, regarded as the best 500 companies, right? Regarded as the best. I'm telling people that at least half, 250 out of 500 companies are going to miss bottom line earnings. Between now and the rest of the year, they're going to at least miss 1 quarter. Now, they might catch up later on, because we can't predict the future like that. We go quarter to quarter. But I'm telling you, half of 250 out of 500 companies are going to miss earnings between now and the end of the year. And who else on CNBC wants to say that? So either they're going to miss, or our analysts are revising down earnings. And I said before on my earnings video, you can go on yahoo.com and check analyst estimates. And I think they even tell you if earnings have been, or sales have been revised down in the last 30 days. You're going to see it's already starting to be revised down. So that's the state of this market. That's video 2.